The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Sell-off? What sell-off? Stocks edging this rally out for its seventh straight day. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. I really wish I would have taken a week off because you know what? Nothing would have changed.
Yeah, it's like the whole Rip Van Winkle. If you were asleep for 5 days, well, nothing really changed.
Exactly.
Yeah.
And this just kind of shows where we are. This is a 5-day dip of the S&P, a 5-day chart. It's really unremarkable, except the fact that it is remarkable. So it didn't really go anywhere. We're up by about 4%, but it is the best weekly gain that we've seen since November. Same thing for NASDAQ 100 and the same thing for the NASDAQ. Just a stark cry from where we started just 5 days ago.
And I think it's even better than that, Alex, because really for all the drama that we saw this week, get this, stocks here in the U.S. and globally are ending it unbowed, heading for what will be their strongest weekly performance since at least November of 2023. The S&P 500 now sitting just about 100 points away from its record high, recouping all of its losses from that massive 6% drawdown that rattled folks to start the month. Now, the economic data was a big spark for that turnaround, but there is still that push-pull here between the bad data and the good. Those forces on display with yesterday's strong retail sales report counterpointed today by an absolutely awful plunge in new home construction to the lowest level since 2020.
As we've seen on a day like today, where you've got weaker housing data versus yesterday, where we had stronger retail sales data, is we are still dealing with cross currents in the economy. This is not a straight line in either direction. And when we start to cheer that, okay, the news is Goldilocks, like you kind of get hit with something in the opposite direction.
Well, if we want to go back to the good news, one big upside today is that U.S. consumer sentiment is up, rising in early August for the first time in 5 months. Optimism about finances, and get this, more optimism about the state of politics because Joe Biden dropped out of the presidential race. His replacement, Vice President Kamala Harris, out on the campaign trail today, making a detailed pitch on how she would shepherd this economy, a pitch that includes sweeping new federal subsidies for parents, price controls for rental homes, as well as pharmacy drugs. Alex.
Yep, we will get to that throughout the next 2 hours as well. So here's another way of looking at this really solid week that we've had. Now, we mentioned it, right? The S&P up the most since November of 2023. There's another way to look at it, too, that here is where we had the soft landing Goldilocks scenario, right? Stocks didn't really do that much, just kept hitting record high after record high. This was the hard landing debacle, the hard landing fear that everything was going to be taken out, data, jobs were going to drop, and the Fed was really going to have to step in with that emergency. And now we've just kind of repriced, no longer pricing for disaster. And if we're back to Goldilocks, then how do you play that when there is so much uncertainty over the next couple months, Romaine?
Absolutely. We're going to get to that and talk a lot about the markets today, but we do want to kick off the show with politics. Vice President Kamala Harris out in North Carolina today pitching to the public her economic policies should she be elected president. Joe Mathieu joining us right now, the co-host of Balance of Power. And I know a lot of details, Joe, about this plan, but not because I heard it from her mouth. It's mainly because of the reporting that our reporters here at Bloomberg have done. When she got on the stage a little bit earlier today, did she actually detail what she was going to do?
We got to some of it. You might think of it as kind of an appetizer here, Romaine, because one of the first things Kamala Harris said is that she would have more details on her so-called opportunity economy over the coming weeks. So this is the first salvo, and it comes ahead of the convention next week. Some of it we had told you about, including her attempt here to create the first national ban, a federal ban on price gouging. Today had a lot more to do with cost of living, the price of groceries, coming just a day after Donald Trump was out there with the big grocery store on display in Bedminster. She is offering a couple of specifics on housing, though, Romaine. I'm guessing there was a big family dinner for the campaign staff because that sausage was thawing out in the sun all day. Imagine this. Down payment support for up to 1 million, maybe even more first-time homebuyers of $25,000 each. She did detail that today. We expected her to say it. And on this day, as you just pointed out, we find out home construction is at its COVID lows right now. You wonder if this would do anything to unlock the market. The problem with a lot of these, though, pay-fors, how do we pay for it? And will you need a Democratic House and Senate to get them passed? That will be the case for a federal ban on gouging.
I mean, before we even get to that, let's talk about the deficit. It's going to be hard for institutions to have already scored this, but we did get some leaks as to what it would look like. What kind of deficit expansion will we be looking at under these policies?
I'm not sure what numbers you're looking at here, but I don't think we have enough details for a real CBO score on this. You can take them one by one, though, and I'll point out removing taxes on tips. This is something that Kamala Harris echoed from the Trump campaign that he's proposing. The group, Taxpayers for Common Sense here, the Committee for a Responsible Federal Budget, rather, said that would create almost $200 billion in deficit spending. Neither campaign has talked again about how they're going to pay for it, other than, in the case of Kamala Harris, a tax on the wealthy. In the case of Donald Trump, he says we'll simply grow out of that. Both of these could be inflationary if they're not paid for. And there's a lot more where these came from. All right, Joe Mathieu, co-host of Balance of Power, all over all things politics here. In the Politics Today, of course, firmly focused on economics, and the market is too. Sinead Colton Grant, Chief Investment Officer at BNY Wealth, joining us right now here as we kick you off to the close here. And Sinead, this was kind of that week where I think the macro really did dominate for a lot of folks, but I'm not sure exactly what it told us, because you had reports today, like on construction spending, showing that awful. You had a retail sales number that I thought was good. And then you had some CPI and inflation data that seemed to suggest that we are still on a disinflationary trend. Is this a good place that we're in right now?
It's certainly a better place than we were in 2 weeks ago. So here's what I think we need to focus on. Absolutely macro matters. The key question is, how much does the Fed cut in September? We know that the economy is not behaving in a completely uniform way. There are pockets of weakness. But here's what we do know now. The consumer is still in a pretty good spot. And it's looking as though that payroll number that we saw a very strong reaction to 2 weeks ago, may be more of an aberration, given what we've seen since.
What's the investment thesis now, knowing what we know?
Well, look, we're going to get rate cuts. We think we see between 75 and 100 basis points from the Fed by the end of the year. They're obviously not the first central bank to start cutting rates. But the big question is, do they do 50 in September? The stronger data we see, the more likely that it's 25. They're absolutely going to start cutting rates, because given what's happened with inflation since rates have peaked, we've got much tighter monetary policy. Our concern is that a 50 basis point move in September could signal to market participants that maybe there's more going on here than they're seeing, that the underlying economy the Fed is viewing as weaker.
We were talking to Seth Carpenter yesterday over at Morgan Stanley that we were pricing out disaster. Like, that's what we've done in this week. If we priced out disaster, should we price back in Goldilocks? And if we do, where do we do that?
It's a really interesting question. And so, look, I think the very strong reaction from 2 weeks ago tells you where the market views risk. And I don't think that's completely gone away, because there's a portion of the market that just can't quite believe that we're going to manage to pull off a soft landing. And where we are very constructive is on equities. We think for the full year, S&P earnings are between 245 and 255, and moving up from there in 2025. But we do think that the economy is ready for rate cuts.
Okay, so that's by the dip where? Small caps, cyclicals, industrials, tech?
A couple of areas. So first of all, you have to be brave when it comes to buying the dip. So we can look back in hindsight now and say, over the last 10 days, it was a great time to add to positions. We do think it makes sense to broaden exposure from here. Maybe you have a little bit of a nibble at small cap. I don't think you go completely back in, because there are some potential headwinds if we do see a little slowing in the economy. But you want to see the rally broaden and not just be so tech focused, even though we do like the tech sector.
I am curious about what's going on outside of the U.S. I mean, obviously, you know, we're doing great, at least if you believe all the numbers. And I'm talking both in terms of the economy and the market. But we've also seen some rallies start sort of bubble up in Europe, even Asia this week. I mean, we've seen China actually rebound nicely over the past 2 weeks here. Is there an investment case for investing outside the U.S. at the expense of whatever positions you have here?
That's a really interesting question. And I think that what we're looking at here is the momentum. You know, you think about how some of those markets have behaved over the first 8 months of the year. China has had a terrible first 8 months. So let's remember that we're seeing a rally from a very low base. Certain markets in Europe start to look more attractive. The central banks there are ahead in terms of cutting rates. You look at the Bank of England, there's an expectation that we're going to see more rate cuts there. But look, you want to make sure that it's always got the right policies to support growth. And that's the key for the US, where we've seen a much more robust economy. We've seen much more supportive policies for corporates, and that's why we've seen the stronger equity market performance. So all told, despite where we are today, we still think the US represents better value than international or EM.
All right, Sinead, always a great conversation. Have a wonderful weekend. Sinead Colton Grant, Chief Investment Officer at BNY Wealth. As we kick you off to the close, we do have some breaking news involving Disney, Fox, and Warner Brothers Discovery, and Fubo TV. Those shares higher by about 20% here after a judge has now blocked Fox, Warner Brothers, and Walt Disney from launching that sports tie-up that they had announced just a couple of months ago. Remember, this was going to be a mashup of their streaming sports services. It was immediately challenged not only by Fubo, but by some other streamers as well. A judge, at least for right now, issuing a preliminary injunction that is going to block that service here, I guess, as they sort through the lawsuit. We'll get you some more details on that and get back to the markets when we come back after the break. This is The Close on Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
Conceivably, there can be points in the business cycle where you might want to say the 12-month forward probability is less than 15%. I'd be reluctant, though, given the political uncertainty and the uncertainty around economic policy, to go significantly below 15%.
That was Jan Hatzius, chief economist, global economist over at Goldman Sachs, weighing in on the odds of a U.S. recession. Well, joining us now is Nela Richardson, chief economist at ADP. She joins us now as well. Hey, Nela, what do you think? We have so much uncertainty ahead of us, whether it's with the election or with rate cuts from the Fed or even with earnings. How does the economy play out in the next 6 months?
Hi, Alex. Well, let's just recap the week, shall we? I mean, what we see is the inflation print has come down. We finally have a 2 handle on headline CPI. We go down to jobless claims. They're now lower than they were a few weeks ago. And then finally, we hit the retail sales number, and we find that the consumer is still resilient. So if I just look at the data this week, I'm looking at some numbers, a lineup that's really strong heading into this third quarter. And I think that's where the economy is heading. Despite fears of a recession, the U.S. consumer continues to be strong, and the U.S. labor market continues to be solid.
So does that mean that we've kind of rewind from a disaster and a hard landing, and now we're back to soft, back to Goldilocks?
The narrative around soft versus hard has, gone from extremes. And I think it's that uncertainty question that you've just raised, because no one really knows what normal is. We know that we are slowing and cooling from something to something, but no one knows what we're slowing and cooling to. We only know what was happening before the pandemic and during the recovery. And absolutely, there is a slowdown from that high hiring rate of the recovery period when consumers wanted to get out of the house and they were spending like crazy. We're no longer there, but what we are seeing is something very much like 2019. And so what we're going into is a very moderate meh economy. It's not high, it's not low, it's just kind of middling right now. And that might continue through the end of the year.
I mean, and so, Nela, though, for the purposes of a lot of investors, I mean, and they look at this economy, they see the cracks, but they also look at financial conditions, and they say, at least in their view, that financial conditions are still easy, the liquidity is still there, the money's still flowing, and at least from a financial aspect of the economy, all things should be good to go, are they?
Yeah. They are. And I know that's a hard answer to accept right now, because what we're seeing is also interest rates at 2-decade highs. And we're seeing a housing market that is pretty much on standstill because of interest rates, yes, but because of low inventory. In my view, the Fed doesn't really have a labor market problem right now. They have a housing problem. And that's what you saw. That was one of the things in the CPI I was particularly attuned to, that those month-over-month shelter costs went up again. And housing is something you can't discount because it's going to be so critically important to inflation and to how much discretionary income consumers actually have to spend, and we haven't solved that yet. And so there is weakness there if you look for it. The headline numbers look good, but obviously no economy is perfect.
But on the housing front, though, I mean, how much control does the Fed have over that? I mean, certainly they don't have a whole lot on the rental side. Obviously on purchases, obviously a drop in interest rates would help things to a certain extent here. But I'm sure you saw the home building numbers this morning for new home starts. And of course, when you look at some of the past data that we've gotten with regards to other sort of metrics like building permits, et cetera, here, they're not moving in the right direction.
That's right. Well, I would argue that the Fed doesn't have a lot of control either on the housing market or the labor economy. They can't force small firms to hire. What gets a small firm to hire is having that demand there. And so in some sense, the real economy is a challenge for the Fed right now if they want to move the needle in terms of growth. The housing market is in particularly concerning because it's been in a decade-long inventory shortage. And even the inventory that we've seen is inventory.
Looks like we have an issue there.
I think we have some issues with Nela's feed there, Alex. I don't know exactly how she was going to finish that thought, but she seems a lot more optimistic than maybe some of the other folks we've had on. And I guess, again, this gets to this whole idea of a lot of these data points being a bit of a Rorschach test, right? I mean, some of these numbers are good. You dig a little bit deeper, you can find bad if you want to find.
And with the starts, that could also be, Hurricane Beryl in the south was impacted. So you have to take all those factors in as well. But it's a supply problem, right? It's not a demand problem. So how does the Fed help that point? Yeah, absolutely. Here, of course, we do get some more economic data next week, but we're really going to have to wait until September. The next, of course, employment report, and then, of course, the big Fed meeting in mid-September. In the meantime, we want to keep things rolling here with an eye on the markets and get right to our top calls, where we take a look at some of the big movers on the back of analyst recommendations. And we start off with Lumen Technologies, chopped down to underweight today over at Wells Fargo, with the firm uneasy about a continuing decline in legacy revenue and limited free cash flow growth. Lumen did recently announce $5 billion of hyperscale AI fiber deals, but the analyst admits that might not be enough to move the needle. The shares, though, nevertheless, actually going up for a sixth straight week. Next in line, let's take a look at Bumble. TD Cowen falling out of love with Bumble, downgrading the stock to hold from buy, viewing the dating app's near-term growth opportunity as uncertain given some of the gradually worsening user trends. A price target going from a street high $22 all the way down to $7.50 here. Nevertheless, the share is getting a modest bid on the day, up by about 2%. And finally, let's take a look at Fox Corp, scoring a touchdown over at Wells Fargo with a double upgrade to overweight all the way from underweight. The analysts bullish on the stock's potential, noting that the sports streaming segment is more of an opportunity than a risk. The price target there set at $46. The shares moving higher on the day by about 1%. And we should just add a little bit of an asterisk to that. We did have some breaking news just a few minutes ago here that big tie-up between Fox, Warner Brothers, and Disney for that new sports streaming service now being blocked by a judge because of some legal challenges by Fubo TV and some other streaming players. We do want to stay in the sell side space and keep things moving along with another double upgrade. And this time it's on Nike. Williams Trading lifting its rating to buy, saying that Tom Petty's return to the company as head of U.S. wholesale indicates a return of the swoosh. Sam Poser, senior equity analyst covering footwear and apparel at Williams. He joins us right now. All right, Sam, I mean, I think a lot of people were excited to see his name crop up. How much can he really do here?
Well, I think it's indicative of sort of an evolution and sort of an increase of the, for lack of a better term, mojo at the company. And while I don't anticipate that, sales are going to inflect anytime soon, I do think that this is indicative of just sort of a better way of looking at the business, and having, given his, from what I understand, relationships and knowledge of the U.S. wholesale marketplace, to really get in there and dig in and better understand what these what these guys are doing.
I am curious about this push. So when his name first popped, everyone said this was going to be the push where that big push that they made into DTC, that maybe they moderate that a little bit, repair their relationships with wholesalers. And I bring that up because we got some earnings out of On Holdings and some of their other competitors that are now actually doing the exact opposite. They're basically saying they want a bigger direct-to-consumer presence here. Is Nike moving in the right direction by re-embracing the wholesale side of this?
Nike. I honestly, what happened was with Nike when they shifted to such a aggressive direct-to-consumer market, they basically didn't stop paying as much attention to their wholesale customers. Not only the wholesale customers that, of course, they got rid of, but the wholesale customers that were still there. So now they'll have to redecide how they're going to, reapproach maybe some of the wholesale accounts that they dropped. But I think the bigger issue is the wholesale accounts that are still around. They really didn't prioritize that. They got rid of a lot of support mechanisms for them, and with Tom Petty coming back, that seems to be indicative that that's changing, because it didn't need to be let's go do wholesale or let's do direct to consumer and then drop the ball on wholesale. They didn't have to be mutually exclusive. You could increase your DTC business and continue your support of your wholesale accounts. That was the decision that was wrong back at the time.
So I'm looking at the stock. Yes, it's gotten beaten up, but it's had quite a run. It's been up for 9 days. We haven't seen that kind of streak since February of 2016. Just in the short run, are we a little overdone on the stock, or do you think there's a little bit more upside just in the short term?
I mean, I'm going to answer it this way. If you read my note, I said very clearly that this is in for the long haul here, because as things evolve to get the product right, to get it in the right places and so on and so forth, that's going to take a good amount of time. And, they're pulling back on core product right now, be it the Air Force One, the Dunks, the Jordan 1s. They're pulling back on that fairly aggressively. And they don't have a lot of big new ideas that can really drive the boat just yet. And that takes time, and it has to be done in a very measured, brand-centric way, which, again, going back to Tom coming back, I think is, he grew up at Nike that way, and I think he didn't think that was about to evolve that way. He wouldn't have come back.
The area of just, women's athletic gear, if we just take that slice, is super fragmented. How do you think that Nike can differentiate within that fragmentation? Just taking a look at that.
You're talking about from a product perspective,
yeah,
or a
product to then increase sales?
How do I describe this? I mean, remember that the product never is good enough. And if you think about a brand, I mean, not talking about Nike, but let's talk about UGG back in 2005, everybody thought it was a fad. Their business went crazy. In 2011, they raised prices. They overdistributed the product. It went down. It took them a while to get it back, and they got it back because they changed the strategy. I think that, of course, you have to have good product, but you also have to bring it to the consumer, men, women, doesn't matter, in a way that captures their imagination and says to them, I understand you. In sports, I'm going to make you better. Or we're going to do this that no other brand can do for you, and then have the product that they have support that idea. Because we've seen lots of great product that fails because it's been, mismanaged. And we've seen some good product. We've seen bad product or product that I personally didn't like at all do much better than I anticipated because it was well managed. And right now we're in the bad managed part of it.
Right.
And that's the evolution. It doesn't matter if it's men's, women's, kids. It just doesn't matter.
Yeah.
All right, fair point. Hey, Sam, we appreciate it. Sam Poser over at Williams Trading joining us there. I'm still just struck on, how much some of these guys like On Holding, for example, have gained so much popularity and market share in such a short amount of time.
Yeah, well, I think it's part of it's great marketing, right? And I mean, I think, look, I say this as somebody who's a big Nike fan and primarily, but they've lost a step. I mean, it's just not the same. And you can see it in the way they market to you, the emails you get, the styles are just kind of the same old. I mean, it's not exciting. And, let's face it, this fashion is about kind of keeping people engaged and excited.
Totally, and sales. Well,
right.
for me,
and let's face
sales.
it, most people are buying these shoes not to run in, they're buying them for fashion.
Yeah, it's a fair point.
Yeah.
Or they're buying it to rush. Did you see this one? Nike is the official sponsor of the University of Alabama.
Wow.
Starting Sunday, the campus is going to be flooded with brands like Nike, Lululemon, Golden Goose, and Hermes as incoming female freshmen participate in Sorority Rush, which is basically a massive fashion popularity contest.
So, my one side of my family, they're all from Alabama.
Okay.
They all went to Alabama. So this is like, their time to shine here. I get totally disgusted by this, by the way. I just, like the amount of money they have to spend on this just to be part of this club.
It's bananas. I would never do it. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So we heard from Vice President Kamala Harris about an hour ago with her economic plan. And one part of it was her housing proposals, either giving first-time home buyers some kind of subsidies, but also tax incentives for home builders.
Yeah, this is interesting. I mean, I don't know exactly how you pay for all this stuff, but there's been a lot of talk on both sides of the campaign here about how you make our housing situation more palatable. So obviously making it more affordable for renters and also making it easier for folks to buy or to build homes here. Again, this is something that she doesn't have direct control over. Ultimately, this is something that's going to have to go through Congress, and you're going to need buy-in.
I mean, that's pretty much for all the economic plans. But the point is, it's also about supply, not necessarily only about demand. So I'm taking a look at the S&P Home Builders Index, slightly higher today. Well, actually, it's down by 0.7%, while the S&P is up by 0.2%. Toll Brothers is coming out next week, so we're looking at that. But one thing that could help the housing market, if you did need the demand push, is lower rates. That could be a boon for other struggling areas like the commercial real estate market. Joining us now for more is Chris Merrill, CEO of Harrison Street Partners, which is big on real estate investing, has more than $55 billion in asset under management. Chris, you say the second half of the year is gearing up to be a very active transaction market. Where and how?
Thank you for having me. We think there's going to be active areas around education and healthcare from the real estate market. And so we've been extremely active and focusing around student housing, things in the medical office, senior housing, data centers, self-storage. So it's going to be a very active push towards the end of the year here.
Is that structural, or is any of that going to be dependent on lower rates from the Fed?
The beauty of some of the alternative segments is certainly rate cuts will help. But what we've seen, and as you were just discussing, there is such a supply shortage right now. So when you think of student housing or senior housing, you have such demographic tailwinds. You've got increasing enrollments. You've got the aging population. And supply has just been absolutely choked off. So what you're seeing is solid year-over-year rental rate increases, well in excess and absorbing any of the sort of interest rate increases we've seen.
When you see that, though, I mean, are there geographic differences, Chris? And I'm talking about from an investment opportunity perspective. Are there parts of this country where you're going to get more of an upside than others?
So it depends on the asset class. So when you take student housing, the beauty of a student housing strategy focusing on the public universities is you can invest across the country in many major markets. So when you think of student housing, we want to be at the largest public universities across this country that have seen 5-6% enrollment increases. When you think of senior housing, you can go into many markets where obviously the aging population is across the country. So when you think of some of these alternative segments that are demographic focused, you really can be across the country. Much different than asset classes like office and in some cases multifamily, where you really have to think carefully about where is job growth, where are jobs being created to drive that demand.
When we talk about, Chris, this idea of what most people assume is going to be a new interest rate cycle, interest rate easing cycle, obviously we could potentially have a change in the political tea leaves here in the U.S. as well. There's been a lot of talk here about how the housing market, how the commercial real estate market is going to be affected by this. So whether we get new policies out of Kamala Harris or new ones out of Donald Trump here, does that at all factor into your long-term planning? I know as an investor, you have to think much more longer term than just the next 4 years, but how much does that factor into it?
It factors into it for sure. I mean, when we think about it, trying to focus on resilient asset classes geared towards demographic allows you to ride ups and down in political changes or in the economy. If you have asset classes where demand is consistent through economic cycles, again, it's a stronger, in our opinion, investment thesis. But some of the things that you're hearing, listening to Kamala talk, some of the things were admirable. Again, if we can reduce red tape, what's the challenge right now in the housing market is the lack of supply. We've got 4 to 5 million shortage of homes. We need to be embracing developers, working with them on local zoning, local entitlement rule to really help them in this building. So that's really going to be important going forward. Is rate cuts are one piece of it,
right? But
regulatory, how can we form partnerships with developers in local towns, municipalities to really help them, get through that progress, get more density so that we can get more units built.
Chris, going back to commercial real estate for a sec, are there any good deals right now, particularly as we're headed into a potentially lower rate environment?
Absolutely. There's tremendous opportunities in real estate. And when you think about, like I said, student housing, you're seeing 6 to 8% year-over-year growth. Good university markets are very resilient. Senior housing, look at the demographic wave, the aging population. We're seeing strong opportunities in medical office, life science, self-storage, data center. So there's many asset classes that are almost like social infrastructure, that they're part of really the fabric of our economy. And so for us, those are great opportunities because what you've seen is a huge reduction in capital flows. So from an opportunistic standpoint, it's a great opportunity to be an investor. These next few years are going to be fantastic vintages if you focus on the right asset classes and the right markets.
All right, Chris, gonna have to leave it there. Great stuff. Chris Merrill, he's the CEO over at Harrison Street Partners. A closer look here at what's been going on in the real estate sector, particularly on the commercial side. And you'll always hear investors like him, Alex, always looking for opportunities, and they continue to find it out there, even with rates where they are. And maybe if rates come down, they get a bit of a boost. There was an interesting headline that just crossed the wire. We got the weekly CFTC positioning data. And for the first time since 2021, hedge funds are net long on the yen.
That's really interesting.
And this is a big deal because there was a great couple stories over the last couple weeks about the return of the yen carry trade, which of course had the big blow up, what was it, 2 weeks ago or whatever it was here, and how everyone was piling back in, of course, and that, of course, puts value underneath the yen. And now we're seeing that reflected in the data, at least here as far as U.S. hedge funds go.
It is really interesting. And if that continues, does that eventually wind up blowing up yet again? Like, are you borrowing yen to buy NVIDIA, and then if you go long, you got to flip it and sell NVIDIA? Like, is that what we're going to wind up seeing?
That's what I was just wondering. Either this is a really smart trade or people have very, very short-term memories.
Both? Maybe both are true. I don't know.
All right. Well, we should point out the yen stronger versus the dollar for a second straight week here. Actually recouping almost all of the losses that it had coming from that big blowout here. The latest headline here, U.S. hedge funds now positioned net long on the yen for the first time since 2021. When we come back, we do want to talk about that big sports streaming tie-up between Disney, Warner Brothers, and Fox. It was challenged immediately in court, and now a judge has said that at least for now, that needs to be put on hold. This at the request of Fubo TV. Those shares higher by 21%. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. Time now for our stock of the hour. Keeping an eye on shares of Fubo. This is the streaming television company, rising about 20% here. This after we learned that a judge is going to temporarily block Fox, Warner Brothers, and Disney from launching that combined streaming sports service. Bloomberg's Chris Palmeri joining us now for a little bit more. And Chris, maybe you can just set the scene for us as to how we got here, because I know in the past we had Disney and some of these other big cable companies were trying to actually push some folks into these streaming services because of the loss of traditional cable television. Charter was also trying to do the same thing with Fubo. And then you had this whole little sports deal that Fox, Disney, and Warner Brothers Discovery decided to do themselves. Fubo held its hand up and said, why can't we get a piece of this action? Where do we stand today?
Exactly. So, the people are canceling cable, And Fox and Warner Brothers and Disney said, well, why don't we just offer people, cord nevers, a package that just includes sports for the diehard sports fans. And Fubo, which is an online TV provider, said, hey, wait a second, we've been trying to do this for years and you wouldn't let us do it. We have to take 90 channels and charge people $75 a month. You won't sell us the sports. And in fact, one of the things the judge in this decision keyed on was the fact that the big media companies had said, we're not going to let anybody else have these rights for 3 years. So that was her decision, that this was just anti-competitive. And whether this opens the door to these companies now licensing these rights directly, just the sports channels, Disney does have plans to offer an ESPN streaming, Papa ESPN product, because they already have ESPN Plus next year. And so how this all shakes out, we don't know. Presumably the companies will appeal, but it was a 68-page opinion, pretty strongly. The judge said basically she didn't see any real people supporting this product and a lot of people arguing against it.
Hey, Chris, what do Warner Brothers, Fox, and Disney do now? I know you mentioned appeal, but then what do they do? If they lose it, what are they left with?
Well, I think the stock reaction to this ruling is telling, and Fubo is way up. The other companies I think they're still up for the day, haven't really moved that much. This is never going to be a huge deal. Fox CEO Lachlan Murdoch said in 5 years they were going to have 5 million subscribers, which is about how many Fox lost last year because of cord cutting. So this was like kind of stemming this erosion, but it was never going to be a huge product. So if they ultimately abandon it, it probably wouldn't have a significant impact.
But is there an issue, though, if this does drag out in the courts or something? Does it sort of at all upend whatever economic model they were trying to move to? Or is this just kind of deferred, I guess, until they sort all this out?
Well, it's certainly a problem because they won't be able to launch before football season, right? So,
which is like in 2 weeks, right?
Might abandon it all, this season. Again, it was sort of like trying to stem the losses rather than open up some great new business opportunity for them. So it certainly kind of would make sense to just abandon it and try to figure out some other avenue to monetize these sports rights. And that's, really what this is about.
Does this preclude, say, Fox, Disney, Warner Brothers tying up for other things? I was reading an article, I forget where it was, maybe it was in Barron's, that talked about here are 5 things that Warner Brothers could do to help itself. And one of them is partner up more, a la Venue. Now what?
Well, this has really been already the year of bundling. I mean, you can buy, for example, a Disney package that includes Warner Brothers Max service. And already, you can go on Amazon and subscribe to these other streaming services. There's so many avenues, and we're really just beginning to see the start of this. Mm-hmm. I mean, people, whether it's Walmart or Instacart, they're throwing in streaming services. There are just so many deals being cut that don't involve a strict joint venture exclusively for these 3 companies. So we're going to continue to see all kinds of ways of mix and matching streaming because these companies know it's getting really confusing. It's hard. You got to subscribe to all these different services. And the people who subscribe to bundles tend to stay longer than the people who just come in and watch a few seasons and then cancel. So we'll definitely see more cooperation.
All right, Chris, we appreciate it. Chris Palmeri, thanks for jumping on with us. You know what they should do, Romaine? They should bundle up all the kind of apps that I can get, not on cable, on streaming, and then sell that to me.
That is a novel concept.
What?
Wow.
That sounds brilliant, does it not? All right, we're about 15 minutes away from the close of trading on this Friday. You're looking at S&P up 0.1%. Gold, though, at a record high, 25.05. Steve Sosnick, Chief Strategist at Interactive Brokers, will be joining us next. This is The Close on Bloomberg.
You have to be brave when it comes to buying the dip. So we can look back in hindsight now and say, over the last 10 days, it was a great time to add to positions. We do think it makes sense to broaden exposure from here. Maybe you have a little bit of a nibble at small cap. I don't think you go completely back in.
Sinead Colton Grant, the Chief Investment Officer at BNY Wealth. She kicked us off to the close just about 50 minutes ago, Alex. With green across the screen here, and I think you alluded to this at the top of the show, if you had been asleep for the past 5 sessions here, you would have no idea about all the turmoil we saw in the middle of the week.
Which is also just kind of crazy. I don't know if that's a good thing or a bad thing. We re-rated so quickly. I appreciate we're only up 1/10, Romain, but we're still at its best weekly gain so far this year. You have to go all the way back to November to see this kind of rally within the S&P in terms of a streak. Also, Nike having a killer day, as we talked about earlier. You also have Nvidia doing really well, the kind of winning streak we haven't seen weekly since back in March. I mean, these are risk-on signs.
Not only risk-on, but it was a much broader rally too, right? I mean, at least on a weekly basis here. So I guess that is the good as everyone still kind of searches for the bad. Not finding it, at least for right now. As we move closer to those closing bells with just about 8.5 minutes to go, Steve Sosnick joining us. He's the Chief Strategist over at Interactive Brokers, and he joins us today here in Studio 2. Great to see you.
Great to see you.
Maybe if you could just kind of make sense of the last really 2 weeks. I mean, let's just go back to end of July, beginning of August. We had that payrolls report. You had whatever the heck happened with the yen carry trade and a lot of stuff in between there that looked like this market was headed for the toilet, just put it mildly. We've recouped all those losses. Where now we have an S&P, not doing much today, but within spitting distance of another record high here. What do you make of it?
Well, a few different things to unpack. I mean, first of all, there was the weakening job numbers, which seems like ages ago. That was literally 2 weeks ago. Then, of course, you had as the yen carry trade blew up. Also, you had a dispersion trade blew up. You had a lot of people selling index volatility and buying individual stock volatility, which works really well when stocks decorrelate, when you have a narrow leadership. The problem is, as the yen carry trade imploded, people went into VIX as a hedge. That boosted VIX. That blew up the people who were short the VIX against the individual equity options. And poof, you had what we had 2 Mondays ago. Since then, it's sort of, people have decided whatever doesn't kill you makes you stronger. And, the same old playbook worked. People have been sort of conditioned to buy dips, and it does tend to work over time, and it worked really well this time. And we're back sort of playing with the same playbook, the same FOMO-induced, the same FOMO leading the market. And here we find ourselves. And, to me, the most telling thing is VIX is below 15. So it's telling me people have no desire to hedge anymore. Forget it.
Well, that's what I mean. Are you encouraged by that? I mean, to go from whatever the intraday was, 60-something, down to below 15 today, I mean, that's just kind of one extreme to the next. I mean, do we not have any middle grounds left in this market?
Well, one would think there should be, shouldn't we? And that's the issue we're looking at here, is we really don't seem to have a middle ground. We lurch when you lurch from one extreme to another, that's not really a stable situation. Where's the equilibrium in that? And the other thing to keep in mind about VIX is, remember, VIX is really the market's, it's not specifically a fear gauge. I sometimes say it's not a fear gauge, but it plays one on TV. But it basically is, it's really the market's best estimate of volatility over the coming 30 days. And it functions in more or less as institutional demand for hedging. So institutions have no demand for hedging, and people don't see a lot of volatility over the coming 30 days, despite Jackson Hole, despite Nvidia earnings, and despite what we've just gone through.
Or is the middle ground now gold?
Gold is definitely taken on a shine. That was a terror. I did not intend to say that. But gold has definitely come to shine in this market. In some ways it's the anti-dollar. In some ways it is a bit of a hedge. It's also, if you do believe that rates are coming down, gold is less punishing to own because the opportunity cost of owning gold is lower. So yes, and anecdotally, since I have no real insight into what they're doing, anecdotally I've heard all kinds of stories about stockpiling in China and India and other places. So you've got the source of demand. All that adds up to a higher gold price.
Yeah, I was wondering if the safety is not in the VIX or the hedge isn't in the VIX, it's in something different. I'm super curious as to what you see in terms of flows from the CTAs, risk parity, the vol-controlled funds. I was so obsessed with them selling for a while, and I'm wondering if they're now back to buying.
They never stop buying. That's the crazy part, is our customers have been net buyers. They were net buyers the way up. They were net buyers the way down. Really? They're net buyers again on the way back up. They just have an undying faith in the market. It's a little more balanced when I look at option flows. They seem to be more two-sided, so they may be using the options more to trade, but they continue to be net buyers. And it's where you think it is. It's the big cap tech stocks. And why buy Qs if you could buy triple Qs? Why buy SOX if you could buy triple levered SOX? And so we see all that activity going on.
Do you think the carry trade has more unwind to go?
It shouldn't it? But it's like everybody put it behind them, and I think the key will be the yen has been helped ever since they basically said the Japanese minister, the Bank of Japan said they're not raising rates. Yeah. It's calmed down quite a bit.
Are you rooting for the carry trade, or are you like a carry trade truther or something?
I'm a carry trade truther. I'm just all these things I was obsessed with for like 48 hours. Now it's like, nah, we're done. Don't worry about it.
So look ahead then, Steve. I mean, like, what's kind of like the next big kind of inflection point? I mean, I guess the Fed meeting next month, and I know we get Jackson Hole next week. Do you think Powell would even use Jackson Hole next Friday? I think it's a week from today, right, when he gives his speech. Do you think he would even bother to use that as a platform to articulate more Fed policy?
Absolutely. He did that 2 years ago. Right. Think about 2 years ago. I happened to do some work on this morning. So 2 years ago, everybody was looking for the Fed pivot, which, by the way, 2 years later, we're still looking for the Fed pivot, mind you. And he basically put the kibosh on that. He came out and said, we're not slowing down here. We're going to continue to raise rates. We're going to continue to fight inflation, and we're going to continue to do QT. Now, we've backed off some of the QT. He's given the sort of go ahead to one rate cut. Yeah. But is he going to come out and say, by the way, you're getting both a good economy and 4 rate cuts, despite the fact that nothing in the SEP, the dot plot, implies that? That he can use that if he's uncomfortable about this.
Is he going to have that much confidence, though? Because 2 years ago, and that was that whole mic drop moment, I mean, he had the data to really have that confidence and to be that bold in doing that. When you look at the data we have now, I don't know. I mean, can you be that forceful?
I don't think he's going to be as forceful as he was then, because the data, in that sense, the data was pointing all in one direction. Yeah. Now you do have conflicting data, but he's going to reiterate the data dependence. He's going. I think, I do think there's a real element to the fact of like, look, you guys have been always so far ahead of us. You've been looking for a pivot 2 years ago. You were looking for 7 rate cuts in January. You're still looking for 4 rate cuts, and we only have 3 meetings left. You guys got to slow your roll a little bit. Is my fear of what he might say. Yeah. And if he says that, the market is not going to particularly enjoy hearing it.
All right. Well, we're definitely going to check back in with you following that speech in 1 week's time. Steve Sosnick, Chief Strategist over at Interactive Brokers, helping us count you down to the close with just about 2 minutes until those bells here. Stocks right now, Alex, hitting session highs.
Yep, by that dip, at a disaster into soft landing. That's what we've now seen.
A wild week here and a full breakdown of all that happened. Coming up right now, this is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through the Closing Bell, a global simulcast. And it starts right now, joined by Scarlett Fu in the television studio, Carol Masser in the radio booth, Jess Menton filling in today for Tim Stenovic here on a Friday. Carol Masser, the stocks once again are in the green across the board.
And first of all, Scarlett, I'm so glad you got the memo on wearing red. I'm a little upset with you, Alex, and a little bit upset with you, Romaine. But having said that,
Did you lose our numbers or something? You couldn't have just texted us?
I don't know. I'm looking at home builders. They're actually higher today, right? Some weak housing data, and nonetheless, we see that move. Some optimism as we head into the weekend, and I feel like what's going to be maybe a big week next week.
That's right. S&P 500 on pace for its best week of the year. Of course, we've been talking all day about that, but when you look from the low that we had earlier this month, the S&P 500's added about $3 trillion in market value, Scarlett.
There is a little bit still of people kind of taking a breather after what we saw this week, but I definitely felt at this start of today's trading day that it wouldn't be surprising if you saw things kind of drift lower into the close because of so many big events next week, whether it's the Fed minutes or Jerome Powell's speech or even the Bank of Japan governor's speech coming up on Thursday night, Friday morning.
Also, guys, volume is really terrible.
Yeah.
It's like, if you look at S&P volume is like down 21% versus the 10-day moving average. So like, I mean, let's be honest, there's not a lot of people trading right now.
There was nobody on the subway platform this morning. Nobody.
Yeah.
The telltale sign.
Yeah.
All right, well, a lot of big moves here across the market space. Of course, a big week for yields, a big week for the dollar, and of course, a big week for stocks, too. Not quite how I think a lot of people thought this week would shape up, but this is what you have. 5 straight days of gains, 7 straight sessions, really going back to last week. and that continues today. 100 points higher on the Dow Jones Industrial Average, or about 0.2%. A similar percentage gain for the S&P 500 as well as the NASDAQ Composite. And the Russell 2000 is going to finish the day higher by about 6 points, or 0.3%. All the major indices higher on a weekly basis.
All right, back to the S&P 500 I go, and 319 names, guys, in the index posting gains in today's session. 180, Scarlett, to the downside, 4 unchanged.
All right, let's take a look at how the sector performances shake out, because on the face of it, it is a mixed day with modest advances in the S&P 500, in the Dow and the NASDAQ as well. So if we could pull that up, we've been having a little bit of problems. It's been on a bit of a delay.
On technical day.
Okay, we don't have that right now. But you know what? If I look at the most active stocks by value, it's pretty clear that you've got a bunch of big tech names gaining. NVIDIA among them, up 1.4%, for instance.
Yeah, I think who's ever in control of that went up to get ice cream upstairs, which is what we put out on Friday, which is really fair, right? Because we're coming to the end of the summer. Having said that...
They put out ice cream?
Occasionally. You never had ice cream?
Never in my life.
That's really sad. All right.
Like Jack LaLanne.
All right.
Oh, my God.
All right. On that, let's get to some of the individual gainers. Ulta Beauty, guys, up another 3% in today's session after an 11% gain yesterday. Of course, we know the news yesterday. Warren Buffett's Berkshire Hathaway disclosing it took a new stake in Ulta, according to the 13F filing. Stock's still down more than 20% year to date, but nonetheless, a gainer in today's session. Fubo, did I mess up? Can I go back to that? Did you guys do that? Yes. Thank you so much. Fubo TV. Some news, of course. That one just up about, 16% here. Big bump to the upside. Fox, Warner Brothers Discovery, Walt Disney blocked by a judge from launching their streaming service just 1 week before it was supposed to be rolled out. A blow for them, but a gain for Fubo TV. So that one really a pop to the upside.
What does Fubo stand for?
Fubo?
Yeah.
Fubo? I don't know.
No.
Do you all know?
No.
Come on. Really? No?
I'm going to research it, so you keep going and I'll research.
Okay, you do that. All right, Dexcom, a top gainer in the S&P 500 and the NASDAQ. It's a medical equipment company, guys. It was up about 3% today. Makes glucose monitoring systems. I'm not really quite sure why it's rallying, but nonetheless, it was an outperformer in today's session. There's been some concerns, I think, about some disappointing earnings they had back in July, but an investigation maybe a little bit into potential violations of federal securities laws. I just don't understand why it's rallying, but it is. So I thought I'd put it out there. All right.
You know what, Carol, since I'm also wearing red today, I'll take the decliners here. Going to start off with Applied Materials. It actually came off of the lows that we did see earlier, but down close to 2% today. It's worst day since August 7th. But what happened here, if you're looking at the semiconductor capital equipment company, did give a fourth quarter forecast that was in line with expectations, but unfortunately it did disappoint bullish investors who were looking for a bigger payoff when it does come none other than AI spending. Another one I'm looking at, and this is one of the top decliners here in the S&P 500, Amcor here down almost 4%, so worst day since May 3rd of 2023 here. This is a global packaging company, and it did slide after sales slowed in the latest quarter here, so it did see sales declines in both rigid and flexible segments. And want to also end on Palo Alto, because we're going to get an earnings update from them at the start of next week, down about 2.7%, worst day since August 5th here, but keeping a close eye on what that guidance could be for fiscal 2025 when it does report on Monday, guys.
All right, I don't know what Fubo actually means, but I think if we go with football and then condense it, I think that's a pretty good bet. But we can still work on that. Taking a look at the bond market, we saw buying all across the curve. We have yields down by about 4 basis points on the front end. But what I found so interesting is we talk about weekly moves. The 2-year yield on a weekly basis currently unchanged. So talk about that round trip. Nothing says that more clearly than the 2-year yields.
Yeah, and it's kind of interesting, too. I mean, we talk about all the movements in yields. And look, I mean, we're now firmly below that 4% mark on the 10-year. And it looks like a lot of the big bets, at least if you look at that CFTC data, guys, that just came out, most people think that the trajectory is going to continue down in rates here as that Treasury buying will resume.
It's amazing. I Googled Fubo. There's nothing, right?
I told you.
It's the name of a sports network that I would name after myself. Fubo.
I like that.
If I had my own sports network.
Oh, now I get what you wrote. Now that makes more sense. I still think it's a condensed football, but go ahead.
All right, let's get to some of the stories that caught our attention. Listen, we've been talking about the weaker housing data, right? And just kind of watching that sector and what it means potentially. One story that caught our attention, if you talk about the high end of real estate, ultra luxury home sales apparently are on the rise. We're talking about 100. $100,000 or above, on pace to set a new record, Jet.
That's right. If you're looking at the pool of potential buyers, it's still small. Top-tier billionaires have watched their wealth swell over the last few years. But, of course, we do have that Bloomberg Billionaires Dollar Index here that you can look in the terminal. But now there are even more homes for them. So it's an interesting read here on the terminal.
It's like Romaine's home.
These are not homes. These are compounds.
Have you noticed we've never been invited? So I'm guessing,
the Sweeney compound. Totally. Alex knows. He always talks about this on Bloomberg Intelligence Radio.
Oh, yeah. The Sweeney compound?
That's right.
Yeah.
It's huge.
It's huge. I think he sold that, though.
He never invites us, though. The word compound, though. It makes clear that there's more than one building. And within some of those buildings are, I'm sure, a lot of art, pieces of art. And what's really interesting is that a lot of people are now borrowing against that art. They're using that as collateral to get some liquidity. And a lot of the banks, Bank of America, for instance, Citi, they're all like building out their art department to be able to provide that service.
I'm actually surprised that this hasn't happened more. Like, this makes perfect sense to me. Like, why wouldn't you do that? Like, you don't want to liquidate it, so why don't just get a loan against it?
Yeah, we've seen this happen in the past here. I mean, like, what kind of art are they taking? Like, can I get some of my old NFTs and leverage that? Or
maybe, to be honest.
It's the old masters kind of art.
Oh, okay.
For me. Yeah.
So,
no paint by number, okay?
But why couldn't you do NFTs? I mean, like, why couldn't at some point that be a thing?
Because they're not worth anything anymore. I am curious. I love this story for a couple reasons, too, because it gets to this idea of kind of all the levers that people of means have to pull to kind of keep spending, or at least to continue their lifestyle here in a way that people on the lower end of the spectrum don't. And not to get all serious about it, but it gets back into that conversation about a K-shaped economic recovery and why we have it.
It was something we talked about here yesterday on air about, the wealth gap that continues to, be in our society. And a lot of it starts with just basic things like being able to buy a house. And then that helps you get to leverage it and so on and so forth. And you're right, Romaine, the wealthy have a lot of different levers to do this with.
That's right. And Carol and I had a segment earlier talking about housing specifically and what they're seeing in that particular segment, but they called it kind of the Southern Smile. We're obviously probably not surprisingly cheaper to live down there than where we are here on the East Coast.
Can you imagine what kind of loan you can get out on a Stegosaurus?
Someone has to assess the value of that before they actually lend you money. So the other thing, Romaine, you were saying that...
So what does that mean? Somebody has to come by and touch it or something?
Exactly. The wealthy have a lot of levers to pull. They also don't have liquidity the same way that I think people of lower incomes do, right? Because all their wealth is tied up in actual assets. Yeah. So when they do have to, come up with money, yes, they can do it, but they'd have to sell, and you don't necessarily want to be forced to sell anything.
Cash poor.
But you know what helps? Not paying taxes on the loans. So it's like, that's the whole point, right? Like, if you're just going to do all these loans against the stuff you already own, you're not getting taxed on that.
Can we go get ice cream?
I just killed the chat talking about taxes. Cool.
I know, we're like, wah, wah.
Wah, wah, wah. Thanks very much, Alex.
Everyone's shoulders just slumped.
All right, guys, have a great weekend, a safe weekend, and we'll see you all next week. All right, Alex is heading out. Scarlett and Romaine continuing on TV, and Jess and I are going to continue here on Business Week. Have a good and safe weekend. We'll see you all next week.
All right, our coverage continues here on The Close. An hour to go, and a focus right now on economic conditions and some of the policy proposals meant to address them. Kamala Harris out with a big speech today ahead of the Democratic National Convention. A conversation up ahead with a professor over at George Mason University. This is coming up next on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bosick. I have to walk over there, Scarlett, but my shoe's untied. So keep an eye on me. So
you'll be okay.
I don't know if I fall, I need someone to pick me up here. And actually, that's really kind of a metaphor for this market, too, because it really did look earlier in this week. This market was headed for a fall, but no, not at all. In fact, it was bullishness all around here. 7 straight days of gains, one of the best weeks for the S&P 500, going all the way back to November of 2023. A modest gain on the day, 0.2%, but across the board for the NASDAQ, the Dow, S&P, the Russell, all were up on a weekly basis. And it wasn't just confined, this rally, to what we saw here in the U.S. European stocks rallied hard as well, and even Chinese stocks. The Chinese NASDAQ Golden Dragon Index that we haven't talked about in months having a phenomenal day and a phenomenal week here as now some investors start to pile back into there. And gold hitting a record high today. I'm not sure that's a bullish signal or not, Scarlett, but you see some of the cross-asset moves here. That's the broader picture. When you take a look at individual stocks, how do they fare?
Well, we start off on a bullish note here as well. H&R Block climbing to a record high, gaining 12% after the tax preparation company had a beat and raise quarter. It also boosted its dividend and announced a $1.5 billion stock buyback program. Also keeping an eye on Nike, gaining 0.9%. But what's more important is the direction of travel. It's gaining for a 9th straight day. That is the longest winning streak in 8 years. But it's still down about 8% from the level it was before its disappointing second quarter earnings in late June. Bill Ackman's Pershing Square, for instance, disclosing a $230 million position, and you had an analyst upgrade as well. So there does seem to be a little bit of a sentiment shift when it comes to Nike. Applied Materials losing about 2% on the day. It did fall as much as 5%, but definitely closed off its lows. The chip equipment maker gave a fourth quarter forecast that was in line with expectations. So it didn't raise its estimate, and that perhaps was a disappointment to those investors who are counting on the AI drive to continue to lead to higher and higher guidance. That didn't happen here. But our top story this hour comes down to housing. It is one of the pillars of Vice President Kamala Harris's just announced economic plan. Now, for low-income buyers, affordability remains the biggest obstacle, whether it's elevated borrowing costs or listing prices. For the uber-wealthy, sales of homes worth at least $100 million in New York City are on pace to set a new record. And later this hour, we're going to discuss the new landscape for broker commissions with the president of Sotheby's International.
All right, but let's get back to politics here in the Democratic National Convention, which does kick off on Monday. About 50,000 people are expected to travel to Chicago specifically for the convention. President Joe Biden, Democratic nominee Kamala Harris, and running mate Tim Walz all set to speak. Kim Ackley joining us right now over at Bloomberg Government. Kate Ackley, and please forgive my flub there. I am curious here, Kate, about what to expect out of this convention. Obviously, we know the outcome is a foregone conclusion. But this was a convention, 4 or 5 weeks ago, that a lot of people thought was going to be a bit of a dud. Obviously, Kamala has brought a little bit more excitement to this ticket now that Biden has stepped aside here. Are we seeing that in the amount of people that are going to be heading to Chicago on Monday?
That's what I'm hearing from my sources. I mean, I talked to people as recently as today, lobbyists, people who work on Capitol Hill, people who work at companies and are, booking last-minute tickets. I talked to one lobbyist whose firm is putting on an event, off the stage, around in Chicago, who said they were worried when they first planned it's a brunch that they're doing. They were worried initially that they wouldn't have enough people come. And now they're at double capacity as of yesterday. So they're seeing really an influx. My sources also said that more members of Congress have been scheduling fundraisers for in Chicago during the convention next week as well.
Okay, so the restaurants and the hotels of Chicago, I'm sure, are very pleased with this turn in people's excitement about the DNC. What about activism around the DNC? We know, relatively speaking, it's been fairly quiet in terms of the pro-Palestinian protesters because, colleges are not in session, for instance, but we do expect a convergence of DNC protesters in and around Chicago.
They've been planning these demonstrations for months. And I don't think that the change at the top of the ticket, from what they've been saying, that's not changing their plans in terms of demonstrating outside, around the convention perimeter where they're allowed to be. We're also going to be watching for any kind of, demonstration or just disunity, I guess, if you will, that crops up inside the convention. If you have delegates that are trying to make a point about the Gaza-Israel situation or other things. But we expect that is going to be a pretty dominant storyline next week.
And of course, we'll be watching for all of that and covering the DNC ourselves there with our Balance of Power team. Kate, thank you so much. Kate Ackley of Bloomberg Government giving us a preview into next week's DNC. Now, Vice President Kamala Harris has vowed to build an opportunity economy as she unveiled her economic agenda this afternoon.
As president, I will be laser focused on creating opportunities for the middle class that advance their economic security, stability, and dignity. We all know that prices went up during the pandemic when the supply chains shut down and failed. But our supply chains have now improved, and prices are still too high.
Veronique de Rugy, Senior Research Fellow at the Mercatus Center at George Mason University, joins us now. Veronique, we know that Kamala Harris has run what a lot of people are calling a vibes campaign, joyful, optimistic, rather than a wonky, policy-filled campaign. Is this a, good vibes economic plan that she's unveiled here?
I don't think so. In fact, I think it's kind of incredible how overnight she's managed to unite economists on the right, on the center, on the left against a lot of her policies. She's put out policies that are probably the most disliked policy among economists, like rent control and anti-price gouging legislations, which is effectively federal price controls.
Yeah, and price controls have not tended to work in the U.S. But I wonder how much of this is, good politics in terms of, I hear when you say you're worried, I feel your pain, but maybe questionable policies, such as the price controls you mentioned.
Oh, yeah. Listen, politicians pander, and she's going on full blown. She's no different. When she's copying the Trump campaign idea of not taxing tips, it's the same pandering that we see from the Trump campaign. When they're talking of enormous child tax credit, that's pandering, right? And I assume politicians do it because it works. But I'm an economist, and I would rather we focus a little bit more, even though I know it's unrealistic, on the impact of these policies, and these are not good.
Well, let's talk about the potential solutions as an economist. And let's take, I guess, what's probably the easier one to address, and that's housing. Obviously, we know we have a big housing shortage, affordable housing shortage, at least in this country, whether you're buying or whether you're renting here. What's a policy prescription that you think would be more effective?
I think a supply side, basically freeing the supply side, allowing much more construction in the country, massive permitting reform would be a good thing. And to the vice president credit, I looked at her platform. There's at least they're paying lip service to permitting reforms. I think they don't go far enough, but I also, unfortunately, a lot of the housing policies that would make a big difference are mostly at the state and local level. So she can't do it alone, or anyone at the federal level can do it alone. But these are the kind of things. You free the supply. What worries me on that front, though, is like when you look at her proposal of a $25,000 tax credits, it's a lot of the same of what the Biden and Harris administrations have been doing, which is propping up demand while not freeing the supply side enough. And that is a product of raising prices.
Okay. And then on the issue of inflation and how you address some of the inflationary issues, of course, former President Trump yesterday made a big to-do about grocery prices, something that Harris tried to address today in her speech here. I know the federal government does not have a lot of levers to pull there, at least not from the White House. When you hear price controls and things like that, I think it kind of sends shivers down a lot of people's spines here. And I'm going to ask you the same question I asked about housing. If not price controls, what policy prescriptions coming out of the White House and coming out of Congress, for that matter, could work?
Well, first, stop proposing policies that are going to be increasing the deficit massively and require enormous amount of borrowing. The one of the things in the speech that the VP gave was supply side, supply chain shock, but that's not, and greed, right? That's not all. Government spending, the enormous amount of government spending without any promise to repay it eventually is one of the factors that led to inflation. Massive, like the large number of studies have actually shown it was mostly a demand side inflation rather than a supply side inflation. It's not greed, it's not supply chain, even though it contributed. The supply chain definitely contributed at the beginning. So what the White House can do is stop proposing all these initiatives that are going to, like, going to increase the deficit. Let's not forget that the increase in the fight against inflation and the rise of interest rates have massively increased interest payments. This means because we don't have the money, we borrow the money. We borrow that for interest payment. That puts pressure on inflation. And her policies, as listed now, would probably add $1.7 trillion to the deficit over a decade, on top of the fact that we're heading to $2 trillion.
Veronique de Rugy of George Mason University, thank you so much for joining us. I guess, Romain, when it comes down to it, it doesn't matter what party you belong to. Whatever policy you're at least proposing at this stage is going to add to the deficit. It all involves spending.
It always adds to the deficit. I don't play these types of politics games as some of these economists like to do. But at the end of the day, we talk about this idea. I mean, you pander on the campaign trail.
Yes.
That's what you do. Otherwise, you're not getting elected. The question is how do you address these problems? We know housing is an issue. We know inflation is an issue. All these things we brought up today. I want to know what that policy prescription is, because I don't think it's price controls, at least not on a permanent basis. And even giving subsidies for housing and things, we saw how that worked out during the George Bush administration.
Correct.
But again, where are the prescriptions that will work? I have yet to hear them.
Well, a lot of them involve local regulations, too, because the local regulations are some of the things that are preventing affordable housing from being built as well. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Christopher Nassetta. He's the CEO of Hilton and about to join the Billionaires Club because he invested alongside Blackstone when that firm took Hilton private in 2007. That eventually led to the IPO in 2013, and the rest is kind of history.
Yeah, this warms my heart. You know, I always love it when, these non-founder CEOs manage to strike it rich. I mean, there was a great story in the Bloomberg Terminal a few, maybe 2 years ago, listing the CEOs that became billionaires that weren't the founders of the companies that they were leading here. And it was a very short list, as you can imagine.
Did they all work with PE?
It was, Tim Cook on there and a couple other people on there as well. That just, managed to work their way up the ladder over the years and collect enough in stock options and rights.
I mean, he definitely earned his keep in that he shepherded Hilton through COVID and changed the company's business model. It's now asset light, right? They license out their name and their software. So it's a different company than I think what many people think Hilton might be.
Yeah, I'm staying at Hilton next week. I'll let you know how it
goes. I want to get your review.
All right, another person I'm keeping an eye on is a person probably nobody's heard of, but any headline that starts off with Florida man, I pretty much click on it. And this is the Florida man you're looking at. His name is Vladimir Galkin. And why did we talk about him? He's actually JetBlue's third biggest shareholder, but he's not an institutional investor. He's not even internet famous. He was basically a meme stock trader. He basically ran an electronics company down in Florida. Apparently, he got involved in the meme stock wave. You remember that, Scarlet Fu.
Yeah.
And made a ton of money off of it. And then he parlayed that, basically following some of the bets that he saw from big titans like Carl Icahn. And somehow he zeroed on JetBlue and has now become their third largest shareholder.
Yeah, he owns 8%. This is unreal.
Yes.
Vanguard owns 10%. BlackRock owns 18%.
Yes, I want to be him. I want to be him. I want to be the Hilton CEO. Who's our third person? I want to be this guy, too.
All right, our third person is Channing Dungey. She's the TV studio chief at Warner Brothers Discovery and expanding her portfolio to also lead the cable networks, including TNT and HGTV. She's got a super impressive resume. Worked at Netflix as the VP for Original Series, president of entertainment at ABC, worked with Shonda Rhimes on Scandal and Bridgerton. But,
blah, blah, blah.
The Warner Brothers Discovery networks are not a good team.
I'm a huge HGTV fan.
You are?
It's like the only thing I watch. Yeah, ask my wife. She hates I just sit there on the couch watching House Hunters. She thinks I'm nuts. But
this is so
honestly,
interesting.
That right there is worth a multi-billion-dollar market valuation on itself. When we come back, we're going to talk about apparel and getting your money back for it. This is Bloomberg. We had a big week of retail earnings, including from Walmart as well as On Holdings. And next week, we get quite a few more. We're going to learn a lot about inventory levels, pricing pressures, and overall a read on the health of the consumer. TJX, Macy's, Ross Stores, just some of the names scheduled to report earnings next week. Mary Ross Gilbert is going to be all over it. She's senior equity research analyst over at Bloomberg Intelligence. Let's start off with the department stores here, Mary, specifically Macy's. We get them in the middle of the week here. And this has been the outlier, department stores, not doing as well as sort of Walmart or even some of these single brand type of stores. What's your expectation?
Yeah, you're absolutely right, Romaine. They have not been sort of the star performer when you look at overall retail. And the winners have been in the off-price space, but we'll get to that in a second. So with Macy's, though, they do a pretty good job managing expectations. So when we look at our data, and looking at consumer transaction, we think that they might come in close to consensus estimate for a slight decline of about 1.4%, but we think they probably beat on the bottom line because they have in the last 8 quarters. But generally, you're right. They're sort of losing share, and the gain has been in the off price, and as you pointed out, Walmart.
Yeah. As consumers trade down. So for a lot of these department stores, and I guess retailers overall, it all comes down to managing your inventory, making sure you don't overorder so that you don't have to discount and try to move the inventory out. How does that work for companies like TJX and Ross, which are taking on the excess inventory that traditional retailers often can't sell?
That's a really good question, Starlet. And with the off price, they're the beneficiary of all this excess inventory out there. And they constantly reiterate on every call that the multitude of this excess inventory is absolutely plentiful. So they have no problems bringing in brands like, for example, at TJX, you get some really high ones. They have the Golden Goose sneakers. They actually had Gucci handbags.
What?
Yes.
So wait, are you serious? Because I have this argument with my wife all the time. She goes to TJX, and I don't understand why she's rummaging around. And then she just talks about how she gets all these high-end brands and other stuff out of there. Here, when did this happen? Has this always been the case?
It's been more recently, and I would say post-pandemic. Because remember, we went through sort of that whole period where we had a shortage, and then coming out of the pandemic, we have this excess inventory. Yeah. But Romaine, also to your point, what we have seen being reported out of the luxury brands is that there's been a decline in spending. Yes. And so that's creating some excess supply out there. So you can even find Yves Saint Laurent at TJ Maxx. So TJ Maxx and Marshalls. And that's where I think we're going to see them outperform is on the Marmaxx side, and on the home goods side. Right. I think that's not going to be the outperformer for TJ Maxx.
All right. We just have to hit up the right TJ Maxx and the right Marshalls, Romaine. That's what it comes down to.
I think our senior producer
or online.
Or online. There you go. Mary Ross Gilbert of Bloomberg Intelligence. Thank you so much for setting us up for next week. Now, that's a great segue, by the way, into our next up segment where we highlight the entrepreneurs and founders moving the needle for our economy, markets, and technology. Croissant is a one-of-a-kind fintech that promises the best prices from the best designer brands. It offers guaranteed resale prices to its users with partnerships from the likes of Bloomingdale's, Neiman Marcus, and more. Here in studio with more is John Howard. He is co-founder and CEO of Croissant. So how does this work? I mean, we kind of explained what it does, but how do you make this work?
Croissant is the first fintech tool to offer guaranteed resale values while you shop for apparel and accessories. We call those guaranteed resale values guaranteed buybacks. We also are the platform for effortless resale post-purchase. So in one click, you can sell things, no more listings.
So while I'm buying it, it'll tell me how much it'll resell for?
That's exactly right. So let's envision that you're shopping for an upcoming event and you've got your eye on a dress from the brand Zimmermann and it costs about $900, let's say. Croissant will show you in real time that we'll buy that back for you should you choose to resell it for something like $480. There's no obligations on you to do that. But what we're seeing is customers are opting to trade up for higher quality inventory, and retailers are seeing a big boost in spend.
I see.
So the average customer who opts into Croissant as part of their checkout is spending 45% more than the baseline at those same retailers.
Is there a time frame on how long that price is guaranteed?
There is, and it varies by brand and by retailer, but it's never less than a year. So
never less than a
never
year.
less than a year.
So I am curious. So from a business model perspective, meaning you're making money off of this here. I mean, if you're offering whatever you said, $480, or if that's the guarantee here, obviously you see some potential to sell it at some point for more than that. I would think, right?
That's so. Keep going.
Right. So my question is who else are you competing with, and do you ever worry though that some of the people that might use your platform, they might realize, okay, if I can get $600 for this somewhere else, why do I take a guarantee at Croissant for $480?
So let me step back for a second and open this up a little bit. So to start with, the current resale ecosystem is fundamentally challenged. It's defined by friction and uncertainty. This is a massive customer pain point. Globally, there's over $2 trillion of resale value sitting in people's closets. This is a fully depreciated value that we could collectively obtain if we chose to resell just our clothes and our accessories. So when I step back and look at that, I say, the stuff that we own and the value therein represents one of the largest latent asset classes on Earth. So Croissant is a response to help unlock that. The reason that we haven't thought about the stuff that we own as assets is because there's been that friction and uncertainty. Croissant's guaranteed resale values bring transparency and liquidity.
Okay.
And what they do next is once people recognize how powerful it is to use guaranteed resale values, they shop differently.
Yeah.
So that point I made around consumers spending 45% more at retailers on average, we're driving lift for retailers in meaningful ways that impact their top line, their loyalty, and their costs, and we earn commissions from those retailers.
Why were the retailers willing to jump on board with this? We showed a board with some of your partners there. I mean, what was the incentive for them?
So guaranteed resale values change shopping behavior in a few different ways. First, they inspire more spending up front. People trade up for better things. They inspire higher conversion, just propensity to go through. And second, they reduce returns.
Yes.
So this has been a huge driver for us in that retailers are able to reduce their return windows or even in the returns flow, surface Croissant's guaranteed resale values as an alternative to returning. So maybe you're on the fence about an item and you say, I don't know if I like it enough to justify what I spent, but then you get nudged to consider keep it, enjoy it, and then later on down the road, you can always resell it with Croissant.
I resell it with Croissant, but what do you do with the article of clothing?
We're a quintessential middleman. So we are connecting into the resale platforms that are already out there and finding the next buyer through the existing websites, whether that's Poshmark or Depop, or RealReal. So we can't go shop Croissant.com for pre-owned inventory. We're really a commerce enablement tool up front, helping retailers see stronger business and users experience effortless resale. And then we take all that burden and use our technology and ops infrastructure to go and move that inventory.
So it sounds like you don't have inventory risk as a result, but why are you called Croissant? What's the link between that and reselling clothes?
I love that question because there really is no grand stroke of genius behind that. It's we often think about this as an unexpected find, right? It's almost a treat to discover that your stuff has more value than you think. Our average user has $2,500 in their collection when they start with Croissant. That's found upside, kind of like a treat on a warm day. We're also multi-layered, and so it references that a little bit as well.
Got it. All right. Thank you so much, John Howard. Really interesting business concept here. Co-founder and CEO of Croissant. It'll certainly make me think twice when I'm buying clothes at any place.
Yeah.
The possibility of being able to sell it back.
Yeah, it's a cool concept. I don't really, sell stuff, but I know that a lot of, particularly women, they'll buy a dress and wear it twice and then sell it back. And
I wonder how many people get stuck with inertia, meaning they plan to sell it back and then they kind of forget in the moment and it just ends up in their closet because it's easier at the end of the day.
Yeah.
Like I know that would, be my issue.
But it's also cool too. You think about just how, I guess we call it revolutionized thrift. Like we're old enough to remember that if you wanted to buy something secondhand, you had to go down to some, stodgy thrift store and rummage around, and now it's just very easy and a lot cleaner and a much seamless process.
Absolutely. So. Thank you, technology. All right, let's take a look at how markets closed on the day. Up arrows all around here, and that's the case for whether it's bond prices or stock prices. The equity index, you can see the Russell 2000 outperforming just a little bit. I mean, we're not talking about big gains here at the end of the day, but for the week, this was the best week for U.S. equities, I believe, in 2024 since November. So it's as if that big market meltdown, we've moved on from it.
Yeah, nothing has really transpired there. And we should point out the Russell 2000 on a weekly basis actually outpacing the S&P.
There you go.
Believe it or not here. We'll be back in a moment. This is The Close on Bloomberg. All right, real estate agents across the U.S. are bracing for a big change that starts tomorrow. New guidelines will go into effect regarding how realtors get paid. This is, of course, part of that settlement involving the National Association of Realtors and that big lawsuit. Joining us right now to discuss is Danielle de la Vega. He's president of One Sotheby's International, one of the premier luxury brokers down there in Florida. Great to have you here on the program, Danielle. Talk to us a little bit here about the compensation structure, because this was a big part of the lawsuit. Basically, the fees that a buyer would pay, the fees that a seller would pay, that's all kind of gotten mashed up now here. How have real estate agents sort of prepared for tomorrow?
Well, traditionally, there's a 6% commission that's paid by the seller
3% is for the buyer's broker, 3% is for the listing broker. And in the past, we used to put that in the MLS, the 3% and the 3%. Moving forward, the biggest change that we're going to see is that now we're not allowed to offer that 3% cooperating broker commission in the MLS.
So, but that still means it's open for negotiation, not only negotiation to the downside for, I guess, the people paying it, but also I would think the realtors can you still negotiate it to the upside?
Oh, yeah. I mean, listen, commissions have always been negotiable. I think that that's a really key point here. Commissions have always been negotiable. And look, sometimes we get paid 3%, but sometimes we get paid 4%, 5%, 6%, right? It's a service that we're providing. And, moving forward, I think that definitely is still going to be an option. It could be 3%, it could be 2%. If it goes down, if the buyer doesn't want to pay as much, but it could be 4%, 5%, or 6%. In many of our new developments, we offer 5%. So I think that that's going to continue to be negotiable, both on the upside and, downside.
Okay, but I think a lot of people are confused by that and don't realize it and think that the 6% rate is kind of set in stone. Clearly, there's room there. There's wiggle room. Having said that, have you seen a lot of people push off closing a transaction until after this August 17th date with the thinking that they can negotiate a lower rate for commissions?
No, we haven't seen that yet, and many of my peers across the country have not seen that yet. In Arizona, the MLS has implemented this as of August 3rd. So they've been working through this. They've been, working with their brokers on how to advise their clients. Their clients are asking questions, the consumer. And look, frankly, it's still, there's a lot of moving parts as to how this is going to happen. But, we're giving our agents as much information as we can to arm them, for the situations that are to come post tomorrow.
Yeah, absolutely. I'm sure you are. And I'm curious, now that the subject of commission is open to negotiation, how are you preparing your agents to make sure that they inform their customers that their services go beyond just advising on this one transaction? How are you making sure to offer as much value as possible in order to earn that 4%, 5%, or 6% commission, which is under scrutiny in a way that it wasn't before?
Well, we've always offered these services. We've always gone over and above, right? Keep in mind, agents across the country, they are the ultimate entrepreneurs. They've got to eat what they kill, right? They've never been, they never wait. They're 1099 employees, right? So they build relationships, they network. It takes a long time to get just, from inception, from the time you meet a client till closing, and even just from contract to close, right? That's where really our services are felt the most. There's so much that goes into it. I mean, when in a state like Florida, where we're seeing so much relocation, we advise on schools. We're a concierge of sort. We help them get into, the best restaurants, and the services go way beyond just finding them a home. And, now we're just the same way we've always had listing presentations. When we represent the seller, we're going to have buyer presentations to showcase what we do a little bit more. And look, we're embracing it. And I think that buyers just need to really understand what it is that we do to be happy to pay that commission.
Yeah. Daniel, I want to talk a little bit broadly here just about the state of the market there. I mean, obviously, you are sitting in what has probably been one of the hottest real estate markets, at least for high-end homes, that we've seen in quite some time here. Has that trend, meaning the activity that we've seen down there in Miami and some of the other counties surrounding there that you're involved in, have we seen that sales growth taper off a bit, or is there still a lot of demand?
No, there's still an incredible amount of demand. I was at one of our developments, Pier 66 in Fort Lauderdale, very close to construction finishing. We got our TCO. I walked it with the developer, and I've got to tell you, it is spectacular. And what's happening is that we're selling a lifestyle. Obviously, there's the tax incentives and everything, but at the end of the day, we're selling a lifestyle, and people still want to be here. We're still seeing many companies moving here. Mm-hmm. And look, summer, the market is seasonal, right? Especially in Dade, Broward, and Palm Beach. So We saw a little bit of a slowdown this summer, but we see that every summer.
Yeah.
And I'm very bullish that come season, and we're already starting to see it in a lot of our sales meetings that we're having, the feedback that we're getting.
Yeah.
Everybody's back. Everybody wants to go out and see property. So look, I'm very bullish on the fourth quarter and what's to come post-election, because we know there's going to be a lot of pent-up demand from the election. But I'm still seeing a very robust market.
How are clients, or some of your potential clients, Daniel, feeling right now about the prices themselves, meaning whatever the list is or whatever they think they might have to pay?
Look, the market is really what dictates the price. Whenever one of our sellers overprices a listing, and this goes for our general brokerage or our development division, it sits. I mean, it sits. Like, you look at some of our markets, and we've got a year and a half of inventory, but when you really dig really, really deep, it's that many of these homes are overpriced. When a home is priced well, okay, on the MLS, traditionally, over the last 10 years, on average, it sells within 95% of the list price. The market is very smart. The market has a lot of information. They've got access to a lot of data, and they know when something is priced right and it's not. And again, this goes for both our general and our developments. And whenever anything is priced right, it sells very, very, very quickly, to the extent that we're still seeing multiple offer situations in our market when something is priced very aggressively. Let's say there's an estate sale or a divorce or something like that.
Well said. Daniel de la Vega, president of One Sotheby's International. Thank you so much for joining us from Miami. Really appreciate it. And of course, Romain, I think about, we were talking about the sale of $100 million homes at a 6% commission. That's a huge amount of money.
Yeah, well, I think that's why they're
I know, but
trying to sell.
For instance, J-Lo and Ben Affleck, they're still married technically, but they're selling their Malibu mega mansion.
Oh, yeah.
Yeah, that's on the market now, right? They listed it for $68 million.
Breaking news for us that they had gotten back together.
No.
Okay.
I mean, it is Friday, so it's a possibility that a headline could drop on a Friday afternoon, because that's what they do. But a $68 million home, I mean, you're talking about $4.08 million commission at 6%. That's a huge amount to move that home.
Yeah, absolutely. Here,
that compound,
and we've seen some big sales here, including in New York. You just had a $100 million.
Those are apartments.
It was an apartment, right? It was a duplex.
It's an apartment.
Yeah, there you go. It's a duplex, Scarlett.
It's not 5 acres, which is how big
it might be on the inside. I've been in some of these apartments, and you're like, wow.
5 acres, dude.
All right.
All right. We have more coming up, right?
Yep. We're going to set you up for what to watch tomorrow. Stick with us. This is Bloomberg.
Counting you down to the Jackson Hole Symposium with all eyes on Jay Powell. The Fed chair is set to speak exactly 1 week from today. The Bloomberg economics team is expecting Powell to, quote, signal a rate cut is coming, but not to indicate whether it'll be 25 basis points or 50 basis points. Estelle O joins us now from Washington. So, Estelle, how is Jay Powell going to frame that idea, given the data that we got this week? CPI, PPI, both good, retail sales, all encouraging.
Right. So we expect Chair Powell to definitely reiterate that it's probably appropriate to cut rates soon. He already said that in the July FOMC meeting. We don't expect him to lock into a 25 or 50 basis point cut yet. Jay Powell is a very data-dependent economist. He's a very data-dependent Fed chair. He understands that we still have, one more labor market print coming up and then one more inflation coming up before he needs to make this decision. He's going to wait for more evidence to come in before he makes that decision. But that doesn't stop us from making a call that we actually think the Fed will cut rates by 50 basis points in September, and that's because we think in the labor market print that comes out in early September, on September 6th, will continue to show that the labor market is in fact deteriorating, despite, as you mentioned, the inflation prints and retail prints we saw this week.
Square that circle for us, though, Estelle, because I mean, we saw the last labor market report. I think the expectations for the next one are not high, but then you look at the retail sales data we got, the inflation print that we got, even the Michigan consumer sentiment data, soft data to be sure, but that's all pointing in a direction that I guess if you're an optimist says people are still spending.
Right. So let's break it down. On the retail sales data, we saw a really strong headline print, but that was mostly driven by a rebound in vehicle sales. And if you look under the hood at what consumers are really spending on in July, they're spending on groceries, and they're not spending on a lot of discretionary items. And I don't know what to tell you, Romaine, but when I feel strained under a high interest rate environment, the only thing I'm spending money on is groceries. So it's not, even though we had a strong headline print, it's not necessarily reflective of a strong U.S. consumer. On inflation is the only thing that's keeping the Fed from keeping the Fed a little hesitant about cutting rates. And yes, this week we got a quite favorable inflation print, and that's actually going to give the Fed a yellow light to go for the rate cut, as opposed to keeping things on hold.
All right, Estelle, I'm going to have to leave it there. Great stuff. Estelle O over at Bloomberg Economics. A closer look here at where the Fed may go next. A big speech by Jay Powell next Friday out at Jackson Hole. As we set you up for some of the potential market moving events over the next week, we're going to start off with Monday in the world of politics and the Democratic National Committee convention kicking off in Chicago.
Yeah, it starts off on Monday, and of course we're going to look to see whether there's going to be protesters. Kamala Harris doesn't take the stage until later in the week, so it's all kind of a drumbeat to that big moment. But there's still earnings, right? We've got Estée Lauder, we've got Palo Alto Networks, among others.
Yeah, absolutely. And then, of course, we move on to Tuesday here. The more earnings, we get Lowe's. We already got a preview of that out of Home Depot. But Toll Brothers, that could be an interesting one.
Yeah, especially since some of these bigger home builders are able to really do the buyback on the mortgages or the pay down on mortgages. So that is helping them gain market share.
Wednesday, we're going to get Target, Macy's, TJX, Snowflake, and Zoom as some of the earnings. Thursday, the DNC concludes, and we get a lot of economic data, jobless claims, global PMIs, and earnings out of Kava and Intuit. And then what's happening on Friday? There it is, Scarlett.
Jackson Hole, Jay Powell speaks. Also, the Bank of Japan governor speaks to Parliament as well.
Thanks for joining us this week on The Close. We'll be back on Monday. This is Bloomberg.